Interest rates rose from under 1% to over 4% over the past 5 years, the sharpest spike since the late 1970s. Back then, this spike triggered the double-dip recession, bringing 2 downturns within 3 years. In 2000, a similar rise in interest rates popped the dot-com bubble, erasing $5 trillion in tech stock value and sparking a recession. And in 2008, rising rates ignited the housing crisis, leading to $10 trillion in lost wealth and the deepest downturn since the Great Depression. Yet today, the economy is growing steadily and stocks are hitting new highs. So if high rates eventually break something in the economy, what could the boogeyman be this time? Banks have been massively fortified after 2008 by regulations like Dodd-Frank that clamped down on risky loans and made the traditional banking system much safer. But it also created a massive lending gap for thousands of small and medium-sized businesses, which were now considered too risky for the big banks to touch. The lending gap was filled by an industry that has exploded in the shadows of the financial world: private credit. You can think of these institutions as shadow banks, and that's what they're often called because they act like banks, but they don't follow the same rules. Private credit has swelled from a $235 billion industry in 2008 to over $2 trillion of assets under management today. These are giant investment firms like Blackstone and Apollo that lend directly to companies with much less regulations and oversight than banks.